Hi, stock investors. JJ here. Welcome back. Well, a bit of a theme today. I've just done one video as somebody thinks that this is going to turn into the roaring 20s. We're going to have a bubble bigger than these dot-com bubble going back to 1929 and that which led up to the Great Depression, but the roaring 20s before that where the stock market was roaring and based on AI. And we've got a video here from Yahoo why Nvidia's rise is similar to the dot-com bubble. So people are starting to say this. You could say that this is a bullish sign where people are still starting to, well, are still saying that, warning about this, but also most analysts have a consensus that 90% of analysts have a consensus that Nvidia, for instance, they've got a buy rating on it. So let's see what's going on here in terms of it being like the dot-com bubble. What's the basis for this? Let's have a look.
Barry, going back to what you were just saying a minute ago here, when we talk about some of the pressures that we could see on the broader market, you mentioned the fact that Nvidia could be the next Cisco. I'm curious more so why, just given the valuation gaps.
Cisco, of course, dropped a lot after the dot-com bubble. It's similar to Nvidia in that way that it got, but the multiples were much more. And maybe Nvidia hasn't finished yet from that point of view.
And we're seeing it's not exactly an apples to apples comparison. So what is it about Nvidia that you're seeing that makes you a bit worried that this could end up like the next Cisco?
Well, yeah. When I say the next, they're already what Cisco was back in 1999. So they are the largest.
Well, the multiple isn't quite there yet, but let's see.
Company, they are the darling. But the valuation difference, consider that semiconductors are capital goods. They're very small, short cycle, early cycle capital goods. They don't typically get an enormous multiple like you would give to a very high ROIC, low incremental cost company like software, where there's enormous return on capital. Sure, they're getting the build out.
They've got pretty good margins at the moment, but will that continue? The fundamentals of Nvidia are pretty strong in terms of their return on capital, pretty good.
AI. But once you build...
But it's cyclical. That's been cyclical in the past. That's the difference.
A bridge, you don't need to build it twice. So the build out will not be a continuous process that you can discount over 45 times earnings over 45 years, even with growth. So that's one thing to consider. The other is that if on NVIDIA specifically, it's called the second derivative, the change in the rate of change of analyst EBITDA revisions. That's the thing that we found that guides the stock. So if you look at the year-to-year change of NVIDIA stock, it's the year-to-year change of the revisions in analyst EBITDA estimates. We published a note on this, and that has rolled over decisively 2 quarters ago. So what we think is the stock's year-to-year change will diminish. It'll still be positive, but it looks for a correction, I would say probably in the high 80s by the late third quarter.
So what he's saying here is it's got ahead of itself and it'll definitely pull back. Well, that's what he's saying. This is not investment advice from me, by the way. It's just general entertainment and educational purposes here. You need to seek your own advice before making any kind of investment. But this guy thinks that it's going to be like the dot-com bubble and it's got way ahead of itself.
And Barry, just lastly here, one of the huge things that we saw with Cisco was a major pullback after the dot-com bubble. Do you anticipate the same type of stock correlation where investors are going to say, okay, who else are they possibly going to sell to? And then you just see a range-bound company for an extended period of time?
No, what happened with Cisco is, and the same thing happened to Microsoft and Amgen and a number of other big cap stocks, is their PE multiple was too high and they earned into it over the course of the next 15 years. So the earnings went up dramatically. As was expected. This happened with the Nifty 50 stocks in the early 70s. They earned very well, but their PE multiples were too high. Their PE ratios, the Nifty 50 in the early 70s, if you look that up on Wikipedia or ChatGPT, that if you look it up, you'll see that those companies had these mid-30s, 40s time multiples. They earned into it over the course of a decade. But what we have today is... They
did earn into it, but the stock price, the point is the stock price was way too high. What he's he's missing there. Well, he's not missing it. He's just not saying it. That the prices came way down. If you think of Microsoft, it was worth $600 billion in market cap, which the market was valuing it at, and the business was fine throughout the next decade. Same with Amazon, and so the price went way down, and then slowly came back up, and those businesses are doing well today. But it took a long time to come back, over a decade.
Is extreme optimism on new technology. Then it was the internet. Now it's the AI. Narrow markets, increasingly narrow markets with a high valuation. Equity ownership was very high, and the day traders and all that. I'm just saying that you have to have been there 25 years ago to remember that it was a very similar feeling environment to today.
I was there
back then. It was similar. It got pretty crazy though. 2021, and when the SPAC boom, felt more like that to me, but not because it's not for a lot of stocks. It's mainly Nvidia and the AI related stocks. So it doesn't seem as crazy yet, honestly.
just opening up my E-Trade account back then, Barry. I was just getting things started. I wish I was around for it.
I was a securities analyst and had been one already for 20 years, and it was or nearly 20 years, and I covered industrial stocks. And so
Okay, so he's been around a long time. He's seen the dot-com bubble. As I said, I was just getting started back then too, and saw that happen. It was pretty crazy, but definitely an educational experience. You kind of had to live through it to really understand what was going on there. Closest I've seen to that is 2021 with the emerging tech stocks, and they did take a dive 70, 80, 90%, the ARK-related stocks, and ARK certainly hasn't recovered. And, it's interesting to see this rebounding so soon, to be with Nvidia in particular. Anyway, I'm going to put a link on the screen to a YouTube video that YouTube thinks that you should watch next. Go and see that now if you want to. And do subscribe. I'll put a subscribe button on the screen. Hit subscribe if you want to see more of this content in the future. And I'll see you in the next one.